Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 5th of April 2020, and yesterday we published our weekly gold and silver update, where we summarised the previous week's financial activities and prices, our view on where gold and silver prices are heading, and a cautionary note to watch where the US dollar is heading. And we place a link to this video in the description box below. Now today we wish to discuss the Fear Mongering Story being publicised, especially by pumpers and their cronies, again with the view in mind to cause ever-increasing panic among gold and silver buyers. So we shall take a very brief look at how the COMEX works, or perhaps more importantly, how traders or dealers or investors or gamblers, you choose the appropriate term, decide to use it. You see, while in the past gold traders would frequently trade over the counter with banks to hedge gold transactions, the majority of gold hedging is now conducted electronically with COMEX Gold futures. Now, although we use the term hedging, which was really the purpose of the COMEX, we are not denying for one moment that it is now being used over and above the hedging purpose, and that many are using it broadly as a gambling den. So we're not questioning that, but we'll just run through very quickly how particularly the physical exchange of gold operates. Exchange for physical, otherwise known as EFP, allows traders to switch gold futures positions to and from physical unallocated accounts, quoted on a dollar basis, relative the current future prices. EFP is a key component in pricing over-the-counter spot gold. Calculating the EFP very simply is to A, take the number of days between spot and futures delivery, take into the account metals and currency interest rates, take into account transportation costs, and take into account refining costs for good delivery of standard bars. Now, the EFP is quoted as a two-way market by brokers or market makers. It fluctuates as a function of supply and demand, while converging towards zero over time, similar to how spot prices converge towards future prices as the futures contract approaches expiration. Now, banks prefer to be short EFP, meaning short the futures contract and long the physical, as they get closer to the futures contract expiration. Rather than having to square their OTC or over-the-counter exposure systematically across wider spreads and with less liquidity, EFP allows traders to hedge the gold markets more efficiently. And that was really the fundamental purpose, or one of the key fundamental purposes of it. Traders typically run over-the-counter positions with an offsetting futures position to be price risk neutral, and use the EFP to manage basis risk. Traders of exchange-traded funds use EFP for arbitrage, while authorized participants create or redeem ETFs. Now, where the problem seems to lie as far as some people are concerned is that they claim there's insufficient gold held by the COMEX to settle transactions in physical terms. Well, to some degree, there's an element of truth in that. But we're now going to read an article to you which indicates that we are nowhere near that position currently, in spite of what these fearmongers are telling us. So let's listen to the article published by Reuters. Reuters article dated April 3rd, 2020. Headline: Growing New York Gold Stockpile Eases Fear of Shortages, by Peter Hobson. The amount of gold stored in vaults in New York, registered by CME Group's COMEX exchange, has risen by nearly 2 million ounces, CME data showed, proving ample to settle monthly contract obligations and easing concerns of shortages that sent prices skyrocketing. Traders worried it would be impossible to fly gold from London to deliver against COMEX contracts after lockdown measures grounded planes and shut several precious metal refineries last month. On March the 23rd, just before gold traded in New York jumped as much as $70 or 4% above London spot prices, contracts representing almost 20 million ounces for delivery in April were open on COMEX, with less than 9 million ounces in store. But the price premium triggered a rush to transfer gold to New York. Total stocks in COMEX registered vaults increased by 1.75 million ounces or 54 tonnes from March the 26th to a 4-year high of 10.5 million ounces, while the proportion put on warrant or made available for delivery doubled to around 40%. Meanwhile, most investors rolled their positions to contracts with future delivery dates, reducing the amount of gold needed for settlement. 24,489 contracts, equivalent to 2.4 million ounces for April delivery, have been redeemed for metal, the highest monthly total since at least 2011, CME data showed. Investors typically use COMEX to gain exposure to gold prices and rarely ask to take metal, which costs money to store. For that reason, far less gold is stored in New York than trades there. If gold is needed, it can be quickly flown on passenger planes from London via Swiss refiners that melt and reshape it to meet COMEX specifications. The next active monthly future on COMEX is for June delivery, with 359,803 contracts active, representing 36 million ounces. Its price is around $25 above London spot gold, suggesting that worries remain. Quote, "There's still some logistical concerns in the market about not having the right bars in the right place," unquote, said Saxo Bank analyst Ole Hansen. But he said the price gap would shrink as refineries reopened and the CME launched a new gold contract that can be settled using London standard 400-ounce bars, as well as the 100-ounce bars it currently takes. The London Bullion Market Association, which oversees London trading, said last week it was working with refiners, shippers and bankers to move metal, including by cargo and charter planes. End of article. Now, whether you believe Reuters or not, or the author or not, what is undoubtedly the case is that if there is insufficient gold stocks held, traders are either encouraged to roll their contracts over or alternatively to settle in cash, something which the COMEX, in its contract with those who participate, can do. So all of this panic about the COMEX being short, whilst we fully accept they would prefer not to be, because they must be seen to be able to deliver the physical as and when it is required, the COMEX won't collapse if it cannot deliver that. Now, admittedly, people will lose confidence in the COMEX if they feel that they cannot trust it to deliver the physical gold, or silver for that matter, that they require. But we have to also be reasonable and say there will be, and there has been over the years, a number of temporary squeezes. And the squeeze, as we all know currently, is not because there is insufficient gold or silver above ground. It's purely the fact that logistically it's extraordinarily difficult to transport it from where it actually is currently held to where it needs to be delivered, especially with a number of mints, mines and dealers having closed down. Now, in addition to that, the article points out that to help alleviate the current problem, they're changing the size of the gold bars at which delivery can then be made. And this, to some extent, should therefore ameliorate the problems that they're encountering. So we are not too concerned currently about what is an undoubted squeeze, because we're confident there is no gold or silver shortage. It's just not where it is meant to be. And as we all know, whenever we desire something in our hands today, we can't become impatient, we become perhaps angry, and in some cases, one becomes desperate. And this is something those who run the COMEX have to contend with. So the bottom line, if you believe Reuters, there's no shortage and there is plenty to satisfy demand. If you do not believe Reuters, then the COMEX can eventually turn around and say, sorry chaps, we'll pay you in cash. So any talk about the imminent collapse of the COMEX or gold having to shoot to $10,000 an ounce overnight, in our view, scaremongering. We can see it rise to $10,000, but other things have to happen for that to occur. And it is far more than the ability of the COMEX to deliver physical gold. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of videos as and when they are published. Also, later today we'll be publishing an answer to one of our subscribers on the Richard and Greg channel, who's raised a number of issues and questions. So by all means, if you have a spare 15 minutes, pop over to that channel. And if you haven't already done so, please subscribe to that too. But that will be going up later this evening. Thank you for listening. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.